You're listening to the Economics and Country Risk podcast from S&P Global Market Intelligence. In each episode, our experts will provide you with the where, how, and when to make decisions that transform your business.
This episode will provide you with a deep dive into the economic uncertainty facing South Africa's economy in 2023. And now, 10 minutes with our expert, Taya Farid, Associate Director for Sub-Saharan Economics at S&P Global Market Intelligence.
What to expect for 2023? I think one thing is definitely certain, that is that the year 2023 will be very uncertain and very volatile, both for the global economy as well as for the South African economy. It's very difficult and very uncertain to predict what the implications is going to be of load shedding on the overall economic performance for this year. What will the opening up of mainland China suggest for global commodity prices in the global rebound? Will the global economy be able to avoid a recession? All of these questions contributing to the uncertainty expected for this year. That being said, bravely, I would like to present our top 5 macroeconomic forecasts for the global economy as well as the South African economy for the coming year. Our first forecast is really that we do expect growth in advanced economies to stall this year, and that global economic growth will find some support from emerging market growth acceleration, particularly from mainland China. We expect commodity prices to reach the bottom during the second half of this year, following a sharp deceleration since the middle of 2022. We expect the US dollar to lose some momentum during the remainder of the year, and we do not expect any further hikes by the South African Reserve Bank. In fact, we expect the policy rate to move sideways for the remainder of the year. For 2023, we expect GDP growth for South Africa to average 0.7%. So we can turn first to our first economic prediction on the global economy, where we do expect the advanced economic growth to stall in 2023 and growth really finding support globally from accelerating output in emerging markets, particularly mainland China. Now, if we look at leading indicators produced by S&P Global, for instance, the global output PMI, it almost seems very likely that the global economy can actually avoid a recession this year, that recession fears actually has started to calm. Our second macroeconomic forecast for the coming year is that we expect the global commodity prices to reach the bottom during the second half of 2023. And as I mentioned during the introduction, we have seen quite a significant deceleration in global commodity prices since the middle of 2022. In fact, the S&P Global Material Price Index, which is an aggregate index of commodity prices, fell by 11% quarter on quarter during the third quarter of 2022 and another 12% during the fourth quarter of 2022. But what is important to realize is that the API is still 38% above pre-COVID-19 levels, which suggests that global commodity prices are actually still very resilient. So really from the fourth quarter onwards, we expect global commodity prices to start stabilizing. And the key reason for this is the relatively fast opening up of mainland China and the rebound we expect in this economy. China continues to remain a large consumer of global commodities, but also a lot of commodities, multiple categories, according to our analysts, face very low inventory levels, and this will also provide some support to prices during 2023. What to expect for oil prices? Of course, the key input to our inflation outlook. So we do expect global oil prices to recover to roughly $91 per barrel during the second half of this year. So moderate rebound expected there. Again, inventory levels extremely low in the energy sector with very little spare capacity available. So any supply side shock in our view can really instigate a sharp rebound in global commodity prices. And I think one risk factor is that analysts should take into consideration when doing their scenario analysis for the coming year. Our third projection is that we do expect the US dollar to lose some steam for the remainder of 2023. Of course, we have seen quite a nice rebound in the US dollar in the past few days. Favorable interest rates as well as investor flight to safety has supported the US dollar during the course of 2022. But these forces are now reversing. We are seeing a narrowing in interest rates spread with the US. And another feature that is feeding into our expectation of US dollar weakness is this persistent and chronic US current account deficit, which will lead to dollar correction over the period 2023 to 2026. So this weaker dollar, we do expect will support the South African rand, and therefore we expect the rand to end the year at roughly 16.60 to the US dollar. But that's not the only factor feeding into our exchange rate forecast. I did mention the narrowing of interest rate differentials. South African Reserve Bank has hiked its interest rates by 375 basis points since the tightening cycle commenced at the end of 2022, also narrowing the interest rate differential with the US. We also expect a small current account deficit of about 1.2% of GDP this year. This is a swing from the surpluses we've recorded in previous years, but still moderate, and we do think that it will limit downside pressures on our exchange rate. That being said, the rand is still undervalued and above its purchasing power parity rates, which we set at around 14.19, 14.18 to the US dollar. Our fourth economic prediction for this year for the South African economy is that we do not expect any further interest rates hikes following the 25 basis points hike we've seen during January. The sideways movement, there's a lot of factors feeding into this expectation. First of all is the lower oil price expectations we're seeing for 2023, and also inflation expectations still relatively contained, although they have been ticking up in recent surveys. But also very important is that our view is that headline inflation will move back within the 3 to 6% inflation target range during the course of 2023, actually by mid-2023, but only reach the midpoint of 4.5% by the end of 2024. There is another feature also in our mind that will play a role in keeping interest rates unchanged this year is the fact that real interest rate levels has now moved into positive territory. What we have seen is during times of uncertainty, the SARB has notoriously widened the real interest rate levels to attract ongoing capital flows to the South African economy. There's still upside risks for rates in the South African economy, and of course have a very vulnerable exchange rate, although we do expect the exchange rate to show some resilience during the coming year, and core inflation also still well above the 4.5% midpoint of the inflation target range. And lastly, we do expect growth in South Africa to average around 0.7% in 2023. And a lot of this weakness in growth, which is down from the 1.1% we expected previously, is due to the extreme load shedding we're experiencing in this economy. Not so much the fact that we are experiencing load shedding, but the excessiveness of this and the duration. And this, of course, will be a massive drag on the potential growth performance of the South African economy. But we're also concerned about the consumer a little bit. Consumer spending continues to make up more than 60% of South Africa's GDP. During 2022, we have seen a lot of catch-up spending and employment creation following the opening up of the economy after the lifting of the COVID-19 pandemic lockdown measures in 2021. So South Africa was able to add 1.2 million jobs to its overall job markets during 2022. Which is really a catch-up phase following the job shedding that happened in COVID-19 period. But we've also seen a massive rise in real average monthly earnings. And this is also a reflection of some delayed payments which came through to households and people in the job market where payments were delayed during the COVID-19 period. And this provided very nice buffer to consumers in the South African economy, but also allowed consumers and households to become net savers, which is actually a divergence from the trends we've seen previously. So there are some buffers for consumers to make use of this savings threshold going into 2023. But as you can see, the savings levels has come down in recent quarters. I did mention that we do expect resilience from emerging market growth, but advanced economic growth will continue to be under pressure. So overall, global growth will continue to slow down during this coming year, and this will have an impact on export performance for the South African economy. Also expecting this slowdown in global commodity prices during the first half of the year. As we said, we only expect stability in global commodity prices towards the second half of this year. There are also, of course, upside surprises, and the installation of renewable energy sources will continue for households and businesses this year, which will continue to support overall fixed investment. And this ultimately can alleviate the impact of load shedding as the year progresses, but very difficult to gauge how big this impact will be. Public sector investment pipeline remains still strong, although the implementation of these pipeline efforts, of course, questionable. Up until now, corporate balance sheets have looked very healthy, although we have seen announcements by some major retailers and other companies in the South African economy during the past few days, suggesting that corporate balance sheets could come under pressure, not problematic, but the cost of load shedding efforts and to mitigate the load shedding in the economy is starting to feed into the balance sheets of corporates. The big question really is if this additional cost will be added on to consumers, which ultimately can derail our inflation as well as our interest rate expectation. So a big risk there. We don't expect any housing or banking crisis in the South African economy, which is also very favorable. We do expect inflation to come down during 2023 to roughly 5.4%. And this, of course, will mitigate some of those pressures coming from higher interest rates and lower wage increases expected for this year. Will provide some buffer to the households. Opening of China can really support global commodity prices beyond our current expectations, which can also provide some support to the economic expectations for the coming year.
Thank you for listening to the Economics and Country Risk podcast. Connect with us on LinkedIn and Twitter, and don't forget to subscribe to the podcast so you never miss an episode.